Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, namely the annual term loan review. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. So what are annual term loan reviews? Long-term loans will be subjected to the annual term loan review function. These loans are generally secured by real estate, but may also include annually renewed lines of credit. Reporting covenants are generally prescribed in loan agreements and will require certain financial information corresponding to the loan type and collateral. The loan's covenants will be closely monitored to ensure the debtor always remains in compliance. Creditors may have certain size thresholds under which these reviews will be conducted, say like $500,000 plus, or smaller loans with higher loan-to-value ratios. Take, for example, if a loan is secured by investor-owned or non-owner-occupied commercial real estate, the creditor is going to want to see a current rent roll showing all the current tenants and the rental terms and conditions. The most recent year-end operating statement will also be reviewed to determine the net operating income, the NOI, to service the debt payments. If multiple non-owner-occupied CRE properties are owned, there should be a schedule of real estate owned that's going to be requested. The most recent year-end business and guarantor tax returns and financial statements will also be required to help verify the accuracy of the assets and the financial performance of the operating statements. Material assets will also be verified, especially the liquidity position. The annual review will likely include a sensitivity analysis for these non-owner-occupied CRE properties, where the analyst will stress certain factors to reflect how much debt service capacity there might be under various stressors. These factors may include determining full occupancy upon stabilization, current occupancy, and even a break-even analysis. A decent stress test will actually break the break-even metrics to show how far cash flow will fall to become insufficient, and stress the variables under a severe economic downturn. Next, a site inspection is likely. Larger loans will likely require a lending officer to perform a site visit to inspect the collateral property. He will also be ascertaining whether the property has any adverse environmental conditions, and if it is being used in conformity with the deed of trust or the mortgage or other loan agreement documentation requirements, and not being used contrary to those terms, like, for example, having a marijuana-related business or MRB operate in the property. Similarly, an owner-occupied CRE property will also require regular financial reporting on an annual basis, if not more frequently when there's been financial deterioration. The same holds true for other term loans secured by equipment. For loans secured by current assets like accounts receivable and inventory, similar inspections and field audits will be made together with all the other reporting. So why is all this important to you? You can expect stepped-up creditor monitoring when there's deteriorating financial performance. As part of prudent credit risk management practices, creditors strive to always be informed about the asset quality of their loan portfolios. Annual reviews are for ordinary times, frankly. Therefore, you can expect there to be, at a minimum, formal annual reviews conducted on your term loan. If you're experiencing financial difficulties, the level of review will become more frequent. It is likely that you will have triggered a technical default on a loan covenant, for example, that will allow the creditor to require more formal financial reporting, and problem loan administration measures will now ensue. If there are multiple non-owner occupied CRE properties in your portfolio, be sure to give a detailed real estate schedule that includes all those things that the borrower's going to conclude anyway. This includes the entity name that owns the property, address, property type, your percentage ownership, the acquisition date, your cost or basis in the property, outstanding loan balance, creditor name, annual rent and income, operating expenses, net operating income, interest expense, principal paid, capital expenditures, your net cash flow, depreciation and amortization expense, and the current estimated market value. The creditor will be able to quickly assess your financial condition of the non-owner occupied CRE properties. In short, when a review of your credit file is underway, take this as an opportunity to be transparent and to work with the creditor. Again, as a business owner, you have an ownership responsibility to not only prepare your financial disclosure documents, but to prepare them in detail and accurately. This is all part of building a relationship of trust. You will need trust when presenting your own repayment solutions if you require a workout or some kind of loan modification at some point. Okay, thank you for joining us. Today we covered the Creditor Tool annual term loan reviews as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.